Hi, everyone. Jack Duvall here. It is Wednesday, February 26th, about 2:14 p.m. Got a new post out on the Substack called Time for a Golden Dome Over Your Portfolio. So let's start it off here. You may have heard that Trump wants to construct an iron dome over the U.S., similar to the one that the Israelis use. Fun fact there's actually three missile defense shields over Israel, and the one that intercepts the low flying missiles and drones is called Iron Dome. Anyway, highly unlikely that we can do a similar Iron Dome over the U.S. for all kinds of reasons that I'm not going to go into here. However, it's impossible for a different reason, more mundane reason, and that is that the name Iron Dome is actually trademarked by an Israeli company. So when Trump learned that, he wanted to rename it, wait for it, the Golden Dome. Trump likes everything gold. So here's this post. I suggest it's time to construct a personal golden dome over your own hard earned investment assets. And of course, I'm talking about buying gold. So, first chart here is the long term price of gold versus the Fed funds rate and the Fed balance sheet. So, let's just look at this. Uh, the white line is gold. You'll see it had this big run in the 70s. Then it went sideways for 20 years from 1980 to about 2000. Then it took off from 2000 to about 2012, consolidated again for another 10 years, and now has started to move up again. I think that's going to continue. Now, here's what's interesting. The Fed funds rate is this orange line. So you see this is when Volcker started going crazy here in the late 70s, early 80s, and raised interest rates dramatically to kill inflation. And since then, inflation, of course, has come down, and the Fed funds rate has come down with some obvious spikes along the way. And now we're getting Fed funds rates going back up, although they've started to go down. The other thing you can see here is the green line is the Federal Reserve balance sheet. It goes sideways, kind of very nominal, low growth until we get the financial crisis in 2008. It spikes up and it starts to grow again. Um, Curious how it grows after we're out of the emergency. Like, what's that all about? Anyway, I've written about that elsewhere. Then it goes sideways, and then we hit the COVID pandemic, and the thing really goes ballistic, gets up to $9 trillion. And since then, they've been running it off every month a little bit, 60 to 90 billion. We're down to 6.8 trillion now. Okay, so that's a historic view. Now I want to talk about why I think gold is a good buy right here. So we're going to look at this second chart. And by the way, if you want to get the full version of this, just go to the Tarot Substack, which is Tarot FSO Frank Sam Oscar .substack.com. This is a free post, so you can get the whole thing there. So this is a chart crime, but I'm going to walk you through it, so don't be alarmed. Shorter term starts in 2015 down here. The white line, all the colors are the same. The white line is the price of gold. Um, and I want to focus on this first box here. So we're looking at the beginning of 2019 through about mid 2020. You'll see the gold price had started to go up before 2019, and then it really ramped up during 19 and in the first half of 2020. So why did it do that? Well, a couple of things. This orange line, the Fed funds rate, had been high, and then it stopped going up first, and then it came down. That's the first thing. So interest rates coming down helps gold. The second thing is that the Federal Reserve balance sheet had been coming down. Look at this from 2018 through the middle of 19. And then it starts going up. And then, of course, it goes ballistic during the pandemic. So the Fed pumping money into the economy, which is what that is, made gold go up as well. And then the last thing is real rates came down. So real rates are defined as here we're using the yield on the 10-year US Treasury minus CPI, so minus inflation. So if, just to do an example, if the 10 year is paying you 5% and inflation is at 4%, you get a 1% real rate, meaning that if you hold that bond for a year, you're able to buy 1% more groceries at the end of the year than you were at the beginning. But if it's reversed and inflation's at 5%, and you're earning 4% on your treasury, at the end of the year, you're only able to buy 1% less in groceries. So that's a problem. And if real rates go negative like that, where you're losing money, even though in real terms after inflation, people tend to exit paper investments where they're getting a negative return and go into gold, which uh, appreciates in real terms. So that's what happened. Um, now, so that was back in 2019 to the mid 2020 time. Now let's look at 2024 to today. That's period 2 here. Very similar setup in my mind. It's not perfect. It's never perfect. But okay, so gold's had a run. All right. But I think it's poised to double from here. So had a run, could go higher. That's where it's down here, started to go up and went a lot higher. If you look at the Fed funds rate, it's been high, flattened out. Now it's starting to go down. That's the same thing that's happened back here with the orange line. Real rates, the purple line has been going sideways for 2 years. That could go negative now. Why? Because inflation is looking sticky, and Trump and Scott Bessent, the Treasury Secretary, are all about bringing the 10-year yield down. I'll take them at their word. So they're going to bring the 10-year yield down. Inflation's going to be sticky. Sounds like you're not going to be able to buy as many groceries at the end of the year because inflation will be higher than what you earn on your 10-year treasury. So people will exit 10-year treasuries and they will buy gold. And lastly, we've got the same scenario with the Federal Reserve balance sheet. This green line's been coming down, just like it was back here, coming down. Okay? It's ready to go back up. How do I know that? Well, just today, the news hit that the Republican majority in the House passed this budget. Now, of course, it's not law yet, but they passed a budget, which is the first step, where the CBO estimates that it will add 4.5 trillion to the deficit over the next 10 years. And as part of that budget, they also included an increase in the debt ceiling by 4 trillion. So they know what the deal is. This budget is going to increase the deficit, and then it's going to and of course increase the debt, because that's how it works. If you spend more than you take in, you have to borrow the difference, and that shows up in the debt. So I think this is going to stop going down and will stop going up again. That's also bullish gold. Okay, then some wild cards here. You may have heard that there's been a lot of talk about the Mar-a-Lago Accord. Now I'm going to write about this later. But what it means basically is kind of distressed reorganization of the U.S. debt, just like companies do. So company borrows a lot of money, doesn't make so much money, starts to go out of business, and they go back to the bondholders and they say, look, we owe you $1 billion, but let's just say it's 300 million, and we live to fight another day. We'll give you some equity, and everybody's happy. Actually, nobody's happy, but that's the way it works. Sometimes the bondholders go along, sometimes they don't. That's what the Mar-a-Lago Accord is. Now, one version of this involves taking all that gold in Fort Knox, and this is what you didn't know. It's carried at $42 an ounce. That's how they mark it on the government balance sheet. The reason they do that is a little obscure, but anyway, that's the way it's been done. They marked it up once from like $34 to $42, like 80 years ago. But trading around 3,000 now. So one version of this is that they mark that to market. and we get a bunch of new assets on the balance sheet. But look, what's going to happen in any version of this Mar-a-Lago Accord is they're going to devalue the hell out of the US dollar, probably like 30% or more, while they restructure the debts. And that's going to send gold up by a commensurate amount, because gold is denominated in dollars. And if all of a sudden those dollars are worth 30% less, the gold's going to be worth 30% more. That's just the way the math works. So I've been long gold. I got more long today. I bought the gold ETF GLD at 268.48. I suggest that you do the same, because I think gold is going to go significantly higher from here. Wouldn't surprise me.